In the world of investing, few strategies are as beloved as much as dividend investing. There is something undeniably satisfying about getting paid just for holding a stock. Here are the top 10 Canadian dividend stocks as picked by Financially Wise Canada. For Canadian investors, this strategy is even more powerful thanks to the dividend tax credit, which allows you to earn eligible dividends in a non-registered account with a lower tax bill than regular income. When combined with the tax-free power of a TFSA, dividend stocks can become a money-printing machine for your future. To analyze a stock for both dividends and growth, often called dividend growth investing, you cannot look at yield alone. You need a framework that evaluates the total return potential, income plus capital appreciation, and the safety of that income. The total return filter. This metric combines dividend income and growth and is a popular rule of thumb among dividend growth investors. The formula: current dividend yield plus 5-year growth rate. The target score: look for a score of 10% or higher for most stocks. Example: if a stock has a 3% yield and grows its dividend by 10% per year, the score is 13, so this passes. Exception: for utilities, telecoms, and REITs, which naturally have higher yields but slower growth, a score of 8% is often considered acceptable. Let's get started with the top 10 Canadian dividend stock picks. These companies are the bedrock of many Canadian portfolios. They have a long history of paying and increasing their dividends. Enbridge, ENB.TO. Sector: energy infrastructure. Why it's a pick. Enbridge is a giant in North American energy, moving about 30% of the crude oil produced in the continent. It is a favorite for income-focused investors due to its consistently high yield. Dividend yield is 5.6% to 6.0% paid quarterly. Stock price has increased 48% over past 5 years. This is 9.6% growth per year on average. 9.6% plus 5.6% dividend yield is 15.2% and passes our dividend growth formula. Next up is Royal Bank of Canada, RY.TO, Canada's largest bank. Why it's a pick. As Canada's largest bank, RBC is the definition of stability, earning over $62 billion in 2025 and is one of the largest international banks. It is a stock you buy and hold forever. Dividend yield is 3.0% to 3.5%. While its yield is lower than some peers, it offers an excellent balance of capital appreciation and dividend growth. Payout is quarterly, with 122% growth over 5 years. This is 24.4% growth per year. 24.4% plus 3% dividend is 27% and passes the test. Next is our third dividend stock pick, Fortis Inc., FTS.TO. Sector: utilities. Fortis is almost a bond-like equity. With regulated utility assets across Canada, the US, and the Caribbean, their revenue is predictable. They hold one of the longest streaks of consecutive annual dividend increases in Canada. Dividend yield is 3.6% to 4% with a quarterly payout with 34.5% growth over the past 5 years. This is 6.9% on average per year. Now 6.9% plus the 3.6% dividend yield is 10.5%. This passes the test. If you are finding value from these posts, please remember to like, subscribe, and share this video. If your primary goal is maximizing immediate cash flow, then these next few stock picks often offer higher starting yields. These are often found in the Canadian Dividend Stocks Aristocrats list. Number 4 is Bank of Nova Scotia, BNS.TO. Often referred to as the International Bank due to its exposure to Latin America and USA, Scotiabank typically offers one of the highest dividend yields among the Big 5 banks. The dividend yield is 5.5% to 6% with quarterly payouts. So with 47.8% growth over 5 years, this is 9.56% per year. This 9.56% growth plus 5.5% dividend is 15.06%. This passes the test. Number 5 is Emera Inc., EMA.TO. Emera Incorporated is a publicly traded Canadian multinational energy holding company based in Halifax, Nova Scotia, a silent giant generating large profits. Dividend yield of 4.4% and a quarterly payout. With 24.4% growth over 5 years, this is a conservative 4.8% per year. However, this 4.8% plus 4.4% dividend is 9.2%. This does pass the test. The reason it made the list is, Emera has large expected growth projections, and with its conservative growth rate over the past few years, this can really take off. Plus, you have the safety of the dividend. Number 6 is TC Energy, TRP.TO. In energy and pipelines, similar to Enbridge, TC Energy operates a massive network of natural gas pipelines. They have raised their dividend annually for over 2 decades. Dividend yield is 4.5% to 6%. With 44% growth over the past 5 years, this is a 8.8% growth rate per year. This 8.8% plus 4.5% dividend is 13.3%, and this passes the test. Let's keep it rolling. Next on the list is National Bank, NA.TO. The National Bank of Canada is the 6th largest commercial bank in Canada. It is headquartered in Montreal and has branches in most Canadian provinces and 2.4 million personal clients. National Bank is the largest bank in Quebec and the second largest financial institution in the province after Desjardins, with a dividend yield of 2.82% and a quarterly payout. This should fit perfectly in your portfolio. With 145.3% growth over 5 years, this is 28.7% growth per year. 28.7% plus 2.82% dividend is 31.52%. This more than passes the test. Up next is our 8th pick, Canadian Utilities, CU.TO. This company holds the record for the longest track record of annual dividend increases in Canada. If consistency is your number one metric, this is your stock. With a dividend yield of 4.3% and a quarterly payout. With a 35.4% growth over 5 years, this is 7.08% per year. 7.08% plus 4.3% is 11.38%. This passes the test. Number 9 is TD Bank, TD.TO in the banking and financial sector. Attractive for long-term growth, stability, and consistent income. Benefiting from its strong Canadian presence, growing U.S. market access, and a solid dividend history, making it a solid choice for risk-averse investors seeking steady returns and capital preservation. TD Bank has a dividend yield of 3.34% and a quarterly payout frequency. TD grew 79.7% over 5 years. This is 15.9% growth per year. 15.9% plus 3.34% dividend is 19.28%. This passes the test. Our last stock pick is Manulife Financial, MFC.TO in the insurance and banking. With a strong presence in Asia, Manulife offers exposure to faster-growing global markets while still being a Canadian blue-chip payer, with a dividend yield of 3.5% and a quarterly payout. Manulife has been a quiet compounder. It has grown 123.35% over 5 years. This is 24.67% per year. 24.67% plus dividend of 3.5% is 28.17%. This more than passes the test. Final strategy, the DRIP. To truly unlock the power of these stocks, consider setting up a dividend reinvestment plan, DRIP. This automatically uses your dividend payments to buy more shares of the stock, often without commission. Over 10 or 20 years, this snowball effect can turn a modest investment into a massive portfolio. There you have it. An equal weighting of all the mentioned stocks in this portfolio will give you a 4.04% yield, along with a 14.05% per year growth rate. That's 70.45% over 5 years. This portfolio passes the test. Please like this video, leave a comment, share, and subscribe to our channel. We would appreciate that so much.